On a Monday in November 2022, Sam Bankman-Fried was worth $26 billion. He was 29 years old. He was on the covers of business magazines. He had donated hundreds of millions to political campaigns. He had testified before the United States Congress as a voice of reason in the crypto industry. By Friday of that same week, FTX, his exchange, the second largest crypto platform on the planet, had filed for bankruptcy. $8 billion in customer funds were missing. Bankman-Fried was under house arrest at his parents' home in California. This was not a market crash. Crypto prices did not fall and take FTX with them. FTX collapsed because customer money deposited by ordinary traders who trusted the platform, had been quietly moved to a sister company and used to make enormous, highly leveraged bets. When those bets went wrong, the money was simply gone. The vocabulary used to conceal? This was dense, technical, and deliberately intimidating. Today, we make it readable. Welcome to Deal English, where real business stories teach you the English that matters in the real world. This episode covers the collapse of FTX. It is a story about trust, about incentives, and about what happens when the people holding your money answer to no one. And it contains 10 business English terms you need to understand any financial scandal, in crypto or anywhere else. To understand how FTX fell, you need to understand how fast it rose, because the speed itself was part of the problem. Sam Bankman-Fried, known everywhere as SBF, founded FTX in 2019. He was 27 years old. Within 3 years, FTX had grown into the world's second largest cryptocurrency exchange by trading volume, handling billions of dollars in transactions every single day. It had naming rights on a major sports arena in Miami. It had celebrity endorsements from some of the most recognized faces in American sports and entertainment. Its balance sheet, according to its own promotional materials, showed billions in assets and a healthy, profitable operation. The company had raised enormous sums from sophisticated investors. It had attracted venture capital, but the story of who else funded FTX and how was far more complicated than a standard funding round. SBF had, in parallel to building FTX, been running a separate trading firm called Alameda Research. This distinction matters enormously, as we will see. What SBF had built was, on the surface, a masterclass in personal branding. Personal branding is the deliberate management of how an individual presents themselves to the public and to professional audiences. SBF cultivated a very specific image. He dressed badly on purpose. He drove a used Toyota. He slept on a beanbag in the office. He talked constantly about a philosophy called effective altruism, the idea that he was making money only so he could give it all away. He was the anti-Wall Street billionaire, the one you could trust precisely because he did not seem to care about the money. That image did enormous work. It disarmed journalists. It reassured investors. It convinced regulators that here, finally, was a crypto founder who deserved to be taken seriously. It was also, in critical respects, a performance. To understand why FTX collapsed, you need to understand one specific financial instrument, the FTT token. Like many crypto exchanges, FTX had created its own digital currency. FTT was the native token of the FTX platform. Holding FTT gave users certain benefits: discounted trading fees, access to special features. The token had a market price that rose as FTX's reputation grew. By late 2022, the total market value of all FTT tokens in existence was several $billions. Here is where the problem begins. A leaked balance sheet from Alameda Research, SBF's trading firm, showed that the single largest asset on Alameda's books was not cash, not Bitcoin, not any widely held asset. It was FTT. Alameda Research, the firm making enormous trading bets on behalf of FTX, was holding billions of dollars worth of a token that FTX itself had created. This is called circular risk in financial analysis. It describes a situation where the apparent value of an asset depends entirely on the continued health of the same entity that issued it. If FTX had a problem, FTT would collapse. if FTT collapsed, Alameda's balance sheet would collapse. If Alameda collapsed, FTX had no backstop. The whole structure was a circle with nothing solid at its center. The balance sheet also revealed something about how FTX treated customer deposits. In a properly run exchange, customer funds are held in segregated accounts, meaning money deposited by customers is kept strictly separate from the company's own operational funds. It cannot be used, invested, or moved without the customer's explicit permission. This is not optional in regulated financial markets. It is a fundamental legal and ethical requirement. What the leaked document suggested, and what subsequent investigations confirmed, was that customer funds at FTX had not been segregated. They had been transferred to Alameda Research and used to fund Alameda's trading positions. This is not a gray area. Moving customer deposits into a proprietary trading operation without authorization is, in most jurisdictions, a criminal act. On November 2nd, 2022, CoinDesk published the leaked Alameda balance sheet. The article was technical. It was widely shared within the crypto industry. For most retail investors, its implications were not immediately clear. But one person understood exactly what it meant. Changpeng Zhao, known as CZ, was the founder and CEO of Binance, the world's largest crypto exchange and FTX's biggest competitor. CZ had previously invested in FTX and held a large position in FTT tokens. On November 6th, he announced on social media that Binance would be selling its entire FTT position, worth approximately $580 million, due to what he described as risk management concerns. The effect was immediate. This is the mechanism of a bank run. A bank run occurs when a large number of depositors simultaneously attempt to withdraw their funds from an institution, typically because they fear the institution is insolvent. The term comes from traditional banking, but the dynamic applies equally to any platform that holds other people's money. Within hours of CZ's tweet, FTX customers began requesting withdrawals. Within 24 hours, withdrawal requests had reached hundreds of millions of dollars. Within 72 hours, customers had attempted to withdraw $6 billion from the platform. FTX did not have $6 billion in liquid funds to return. It had sent much of that money to Alameda. Alameda had lost much of it in bad trades. FTX tried to halt withdrawals. Then it tried to raise emergency funding. SBF reached out to every major investor and institution he knew. He contacted rivals. He contacted sovereign wealth funds. Nobody came. To understand where the $8 billion actually went, you need to understand how Alameda Research operated, and specifically, how it used leverage. Leverage means using borrowed money to increase the size of a financial position. Instead of investing $1 of your own money, you borrow 9 more and invest 10. If the trade goes up by 10%, you make a 100% return on your own dollar. If the trade goes down by 10%, your entire investment is wiped out, and you still owe the $9 you borrowed. Alameda was running leveraged positions across a wide range of assets: crypto tokens, derivatives, private company stakes. Many of these bets were made using customer funds from FTX as the underlying capital. When the broader crypto market fell sharply in 2022, which it did, dramatically, many of those positions collapsed. The borrowed money amplified losses in exactly the same way it had amplified gains during the bull market. This is the core danger of counterparty risk. Counterparty risk is the possibility that the other party in a financial agreement will fail to meet their obligations. Every FTX customer who deposited funds was, without knowing it, a counterparty to Alameda's trades. When Alameda failed, the customers were the ones who absorbed the loss. The relationship between FTX and Alameda was never disclosed to customers or investors in any meaningful way. SBF had maintained the fiction that they were separate entities operating independently. In reality, Alameda had a secret backdoor into FTX's systems that allowed it to borrow customer funds without triggering the platform's standard risk controls. On November 11, 2022, 9 days after the CoinDesk article, FTX filed for bankruptcy. SBF resigned as CEO. A restructuring expert named John Ray, who had previously overseen the Enron bankruptcy, was brought in to manage the collapse. Ray's assessment was direct. He said he had never, in his entire career, seen such a complete failure of corporate controls. No accurate financial records, no independent board, no internal audit function, loans to executives undisclosed and unrecorded. $8 billion in customer funds were unaccounted for. SBF was arrested in the Bahamas in December 2022 and extradited to the United States. He was charged with multiple counts of wire fraud. Wire fraud is the use of electronic communications, phone calls, emails, digital transfers, to deliberately deceive people for financial gain. It is one of the most broadly applied financial crime statutes in the United States legal system, covering almost any scheme conducted across digital or telephone networks. He was also charged with money laundering, the process of disguising the origins of illegally obtained funds by passing them through a series of transactions to make them appear legitimate. Prosecutors alleged that customer funds had been moved through a network of accounts in ways designed to obscure their origin and destination. In October 2023, after a trial lasting several weeks, Sam Bankman-Fried was convicted on all 7 counts. He was sentenced to 25 years in federal prison. The conviction turned on one central argument from the prosecution. SBF had told customers their funds were safe. He had told investors the company was solvent. He had told regulators the operation was clean. He had known at each of those moments that none of it was true. That gap between what he said and what he knew is the definition of fraud. The FTX collapse did not happen in a vacuum. It happened in a regulatory environment that had consistently failed to keep pace with the growth of the crypto industry. And that failure was, in significant part, the result of deliberate lobbying. SBF had spent hundreds of millions of dollars on political donations in the years before the collapse. He was, by some measures, the second largest individual donor to the Democratic Party in the 2022 election cycle. He testified before Congress. He met with regulators. He published policy papers arguing for a specific regulatory framework, one that critics later noted would have benefited FTX while disadvantaging smaller competitors. This strategy, using financial and political influence to shape the rules of your own industry, is called regulatory capture. Regulatory capture occurs when a regulatory body, meant to act in the public interest, instead begins to advance the interests of the industry it is supposed to oversee. It does not require corruption in any simple sense. It happens gradually, through access, through expertise, through the revolving door between industry and government. The result in the crypto industry was an exchange operating with billions of dollars of customer funds. No meaningful external audit, no segregation requirements, and no oversight body with both the jurisdiction and the will to examine its books. When the collapse came, regulators moved quickly to investigate. The Securities and Exchange Commission, the Commodity Futures Trading Commission, and the Department of Justice all opened cases. But for the 1 million customers who had funds on the platform, the investigations came $8 billion too late. The fallout from FTX extended far beyond one company and one founder. It sent contagion, a term we covered in episode 9, through the entire crypto ecosystem. Companies that had exposure to FTX, or to Alameda, or simply to the FTT token, found their own positions suddenly underwater. BlockFi, a crypto lending platform, filed for bankruptcy within weeks. Genesis, a major crypto lender, halted withdrawals and eventually collapsed. Several venture capital funds that had invested in FTX wrote down their positions to zero. The total estimated losses across the ecosystem ran to tens of billions of dollars. The broader effect was a collapse in market confidence. Market confidence describes the general level of trust that investors and participants have in the stability and fairness of a market. When market confidence collapses, it does not just affect the bad actors. It affects everyone operating in that space. Legitimate crypto businesses found themselves unable to raise capital. Institutional investors who had been cautiously entering the space pulled back entirely. The price of Bitcoin fell by more than 70% from its peak. For ordinary retail investors, people who had put savings into FTX because a celebrity had recommended it, because the interface was clean, because SBF seemed trustworthy, the losses were permanent. Bankruptcy proceedings take years. Recovery rates in crypto collapses are typically low. Some customers received partial restitution. Many received nothing. The story of FTX is, at its core, the story of what happens when due diligence, a term from episode 5, fails at every level simultaneously. Investors who did not verify, regulators who did not inspect, journalists who celebrated rather than questioned, and customers who trusted a brand rather than a balance sheet. The FTX story is not really a crypto story. Crypto provided the vocabulary and the speed, but the underlying structure of the fraud is as old as finance itself. Someone builds a platform that holds other people's money. The platform grows fast, which creates the impression of legitimacy. The founder projects confidence and vision. Complexity and jargon prevent outsiders from examining the books closely. Internal controls are weak or absent. And the money, quietly, goes somewhere it should never have gone. John Law did this in France in 1720. Charles Ponzi did this in Boston in 1920. Bernie Madoff did this on Wall Street for 40 years. Sam Bankman-Fried did this in the Bahamas in 2022. The setting changes. The mechanism is always the same. The lesson for anyone working in business, in any sector, is that the burden of verification never disappears. When someone tells you your money is safe, that is not evidence that it is safe. When an auditor signs off on a balance sheet, that is not proof that the balance sheet is accurate. When a regulator approves an operation, that is not a guarantee of solvency. Trust is not a substitute for transparency. Transparency in business means that an organization's financial position, decision-making processes, and potential conflicts of interest are openly and accurately disclosed to all relevant parties. It is not the same as openness. A company can be publicly visible and completely opaque at the same time, as FTX demonstrated. The final lesson is the hardest one. The most dangerous frauds are not the ones that look suspicious. They are the ones that look inspiring. Here are the 10 business English terms from this episode. Personal branding. The deliberate management of how an individual presents themselves professionally and publicly to shape perception and build trust. Circular risk, a situation in which the apparent value of an asset depends entirely on the health of the same entity that created it, making the whole structure self-referential and fragile. Segregated account, a financial account in which customer funds are kept strictly separate from a company's own operational money and cannot be used without explicit customer authorization. Bank run, a situation in which a large number of depositors simultaneously attempt to withdraw their funds from an institution out of fear that it is insolvent. Leverage, the use of borrowed money to increase the size of a financial position, amplifying both potential gains and potential losses. Counterparty risk, the risk that the other party in a financial agreement will be unable or unwilling to meet their obligations, leaving you to absorb the loss. Wire fraud, the use of electronic communications to deliberately deceive people for financial gain, one of the broadest financial crime statutes in the United States legal system. Money laundering, the process of disguising illegally obtained funds by passing them through a series of transactions to make them appear to come from a legitimate source. Regulatory capture, the process by which a regulatory body, created to protect the public, gradually comes to serve the interests of the industry it was designed to oversee. Transparency, the principle that an organization's financial position, decisions, and conflicts of interest are openly and accurately disclosed to all relevant parties.